What you're often doing early stage, right, is that you're talking to people who might use your product and you're using them to determine which features to build to figure out how to get to product market fit. Well, ask people what they want to pay at the same time. Don't leave that to be a separate part of the conversation that you sit around and be like, oh, no, how should we charge this? I don't know. Your best people who are going to probably at least give you some indicators are going to be the people you might be selling to. Now, there might be a fear to bring up that as part of the conversation, right? But if you don't bring it up, you can never get an answer, and you're going to need to tell people a price eventually, so why not start earlier? It's not only about like, hi, do you want to pay $2,000 or $1,000 for this? Because that already presumes they know how they want to pay for it. And you don't know that yet. Maybe they think in this type of unit. Maybe they would change their mind a lot if they had to go above a certain threshold, at which point they need to go ask their CEO for permission. There's so many hidden factors that actually you want to have a pretty open discussion about how do you think about this? How would you think about the value that you're going to get from this product? At the end of the day, what you're trying to get, you could backtrack from ROI is going to be this. We think that ROI will happen this way. Therefore, this is probably the way they'll find value. Therefore, this is maybe how we'll price it.
Welcome to the Invisible Inc. podcast. I'm your host, Shubha Chakravarti, Chief Financial Storyteller at Achieve. Our guest for today is Ingrid Bonde Åkerlind. Ingrid is a pricing expert and a principal at XaaS VC, where she invests in and partners with European SaaS startups. She has extensive experience building out go-to-market strategies at multiple companies, including at Volumental. She also led pricing for BlaBlaCar, which is a French tech unicorn. Ingrid has extensive experience in sustainability and energy policy and research, and has a master's degree in technology and policy from MIT. Now, here's Ingrid. Hello, Ingrid. We're so happy to have you on Invisible Inc. today. Thank you for being here.
Thank you so much for inviting me.
So you're an expert in one of my favorite topics, which is pricing. So just to get us started, can you tell us a little bit about your work and kind of what drew you to this area?
Yeah, for sure. So today I work as an investor at a venture capital fund. So I get the joy of actually getting to talk about the topic of pricing with lots of different founders of different startups, generally quite small ones, sometimes a little bit bigger, but not enormous enterprises. That's not truly what I talk with these days. But before I was an investor, I spent several years working as a VP marketing and growth, and before that as actually a pricing lead in a large scale-up. And so I had the chance to get to do it firsthand, and once you sort of fall in love with the topic, you don't leave it, so to speak. But the original story of like why pricing was literally my manager came to me one day, and this was December 2015 or 16, I don't quite remember, was like, oh, by the way, so we need to focus on pricing and here, figure it out. And that was basically what we had to deal with. And so it was it started off as a project to really dive into something that I didn't know much about, but which I will add as well, there wasn't a lot of literature about sort of pricing of digital products back then, especially not the business model I was working with then was actually a C2C marketplace. So you're dealing with a digital marketplace. Pricing literature that existed, the theories had very much been developed for supply and demand and elasticities for physical goods. So you could actually, by yourself or first principles, figure out a lot of the basics and sort of test and experiment. That's sort of the ethos of how a lot of tech companies are built, which is one reason it sort of also was a really interesting thing to dive into.
Awesome. And if you care to share, was there one big aha in terms of C2C pricing that came up through your work that you didn't find in the literature?
Yeah, so one thing I was working at a company called BlaBlaCar. They're the world's leader in city-to-city ride sharing. Today, they've expanded to multiple product lines, but at the time, that was the main revenue driver from the business. And so drivers are posting seats online, and passengers will purchase those empty seats. The platform doesn't dictate the price. The platform suggests the price, and the driver picks the price. And one phenomenon that we saw, which actually I think I haven't seen as much in other places, is that there was this sort of like price inertia, that even if we were to start recommending a different price, which we're doing, drivers would keep sometimes posting the previous price because they remembered it. And so I think it was a really interesting notion they haven't actually seen explicitly in other places about people remember the original price, and they have that sort of an anchor And then you have to let a certain amount of time pass until they forget about it. But then eventually sort of the new reality becomes the dominant one. But it doesn't happen overnight. But it was very explicit in this marketplace in such a way that I don't think it's explicit necessarily in other places. But you can probably imagine that actually your customers, for sure, they do know ish the price of the competitors. They do know ish your prices, but they actually might remember the prices of sort of a year ago. If prices for our food that we pay for in our grocery stores rise, honestly, it's more basically we're like, oh, this is expensive because I remember what I used to pay for this particular good.
One other thing on that you brought up, right, is this issue of psychology, right? I don't want to say consumer psychology, I'll say customer psychology.
Yeah.
To what extent is psychology a driver? And if you had to split up 100 points between analytics and psychology, how would you split those up in terms of impact on pricing?
I do think that actually depends on what stage of company you're at. Actually, I'll put the framing into these ways. I think actually psychology is just as much as part of B2B pricing as just a B2C pricing in some ways. I don't think consumers are far more like just driven by psychology and then rationality than a B2B buyers. There's a ton of psychology in that as well. But if you are a very late stage company, then you can hire somebody in pricing who actually applies it as a science because you are large enough that actually optimizing a small margin is worth it. If you're an early stage company, the value you're going to get from optimizing is very low compared to the value you're going to get from sort of strategic shifts in a new product line, figuring out a new way to drive growth. So you aren't trying to sort of optimize as much as you are trying to forge out new directions, in which case the psychological piece becomes more important because you're trying to think of what will work in the market, not what is the ideal price point.
I like that. Yeah, that makes a lot of sense. And just one last question, because this is so fascinating. You talked about how psychology is important in B2B pricing, right? And a lot of our listeners are founders of B2B companies, particularly in deep tech. Can you talk about maybe one or two specific factors that you think have an outsized influence on B2B pricing from a psychology perspective?
Yeah, I guess the notion is that there's not necessarily what is expensive or not depends on what you compare it to. So one thing, for example, is that sometimes I ask people, and this is actually something that's related very much to positioning, is if you're developing a new product category, which to your point, if many of the listeners here are deep tech founders, it's a brand new product category. Like nobody knows, like there's not a set price, but there is something else they're probably comparing this against as sort of like a type of a budget item or a type of this thing. So sometimes in those conversations with the founders, I might ask, okay, so is this like being purchased as like, I used to work in retail tech. So it's like, this is a retail experience. Okay, great. Well, what else do you spend on for retail experience? Is this a lot or a little compared to that? And that's actually going to matter like more to the customer necessarily than the cost that you have to produce said thing. So if you call something one thing, it might sound expensive. If you call thing another thing, it might sound cheap.
So framing and anchoring, in other words.
Yeah, so it's sort of like how you frame something will actually shift what you think that it might be. Actually.
Love it. Love it. So now I want to dive into kind of your area of expertise, which is SaaS, or what I like to call more broadly XaaS. Like I see a lot of these businesses, not just in software, obviously, even in like clean tech, health tech, moving into XaaS business models. What are some of the big challenges they face relative to maybe traditional pricing methods?
Yeah, so any sort of X as a service model, what you do very much is you're actually having a customer sign up on day one, but you're actually assuming that they're going to stay with your business for a very long time to come, especially if you have the hardware component to whatever you're selling. Yeah, it's probably a pretty long time commitment because not only are you adopting a new thing, you're actually maybe implementing into sort of a physical environment where it actually will stay for a while. And so unlike when you're doing a one-off transaction, what's a bit challenging is you can't count the profitability of that one-time transaction. You're trying to count on profitability as it stretches over time. So your unit economic calculation becomes a lot more complicated. It's not just like, I paid this much in order to have somebody buy that much, which is simplistic. You have to assume how long will they use it for, And to your point, if you are including a piece of hardware, at what point will that degrade? Well, if you're an early stage startup, you have no idea how often you're going to need to replace the spare parts of that hardware product at all, or that IoT device. And so that's, I think, probably one of the things that becomes more challenging when you're thinking about price as really an input to profitability, which at the end of the day, price is one of the most important inputs into, now I'm using the word unit economic profitability, but for the companies that I work with, that's sort of like where many of them are unprofitable because they're growth companies, but that's really what they're trying to look for.
Got it. And do you have any kind of, I don't want to say simple, but off the top of your head, guidelines or principles in terms of where they even start? You made a really good point. They have no data, right? Like, how do I know anything about these things? So what are some landmarks or some starting points, anything that can help them get grounded or situated within the right zone of pricing, so to speak?
Well, there's not just one perfect price, right? In a sense, if you think of sort of the ultimate business output of your business, you're building your product and you're building a commercial team to sell that product. And actually price is kind of what connects the two together.
Right.
At the end of the day, it is almost like a third limb of the whole thing. It's just the one that nobody happens to own it and nobody happens to have it as their full-time job, because it doesn't warrant having somebody as a full-time job, because the other two things take a lot more sort of resources. But if you're relatively early, I think one thing that's quite important is trying to keep it very tight to product. So what you're often doing early stage, right, is that you're off and your product managers if you're super early stage, the founders themselves, you're doing prospective interviews with users, right? You're talking to people who might use your product and you're using them to determine which features to build to figure out how to get to product market fit. Well, ask people what they want to pay at the same time. Don't leave that to be a separate part of the conversation that you sit around and be like, oh no, how should we charge for this? I don't know. Your best people who are going to probably at least give you some indicators are going to be the people you might be selling to. Now, there might be a fear to bring up that as part of the conversation, right? But if you don't bring it up, you can never get an answer, and you're going to need to tell people a price eventually. So why not start earlier? One caveat that I think is really important is if you're an enterprise, then obviously your user may not be your buyer. And so then it's important to do what I would term as buyer research calls. You need to talk to potential buyers to understand how they would think about it. And when I say when they would think about it, and we can get into more, this is like research now. It's not only about, hi, do you want to pay $2,000 or $1,000 for this? Because that already presumes they know how they want to pay for it. And you don't know that yet. Maybe they think in this type of unit. Maybe they would change their mind a lot if they had to go above a certain threshold, at which point they need to go ask their CEO for permission. There's so many hidden factors that actually you want to have a pretty open discussion about. How do you think about this? How would you think about the value that you're going to get from this product? At the end of the day, what you're trying to get, you could backtrack from ROI is going to be this. We think that ROI will happen in this way. Therefore, this is probably the way they'll find value. Therefore, this is maybe how we'll price it.
Awesome. I love it. And I know we're going to dive into that, so I'll hold that thought, but I loved how you laid out at least a high level starting point to say, don't jump off the deep end, but have an approach that's driven off of an ROI basis, keeping in mind all the other psychological factors. So coming to that, you made a really interesting point. You said pricing is usually the orphan, right? In the startup, nobody owns it. It's kind of assumed. So what are the biggest mistakes you see founders making on this area of price? Because to me, if you just look at pure numbers, it's the biggest driver of profitability, right? Like within constraints. So what I would imagine that this should be top of mind, but I'm sure it's not the case for founders because it's a scary big topic. What are you seeing in terms of on the ground mistakes and how
I think luckily it actually is becoming, at least sort of in the pure software and SaaS world that I live in, I think it actually was becoming slightly more top of mind. But that's actually more because 10 years ago, everyone just did simple seat-based usage licensing, blah, blah, blah. Now with consumption-based pricing, with AI, we're talking about outcome-based pricing. So like suddenly the smorgasbord of menus is increasing. So actually people know that, oh, I have to think about this, which leads you to have discussions around it, right? I think the rep that nobody thinks about it is probably not as true as it might have been 10 years ago. But where people usually go wrong, I mean, the most classic mistake is that people don't price high enough. Or they do price the initial sort of 5 to 10 customers, but then they forget that actually, oh, wait, I'm not selling an MVP anymore. Actually, I've now spent 2 more years in my development resources making this product better. Clearly, it's going to deliver higher value. And I need to remember to shift what pricing I'm charging and how I'm pricing as that happens. So those are the 2 most common mistakes, for sure.
So pricing low, I can certainly understand, right? You're going out, you're feeling pretty tentative, you don't know anything.
Mm-hmm.
What can a founder do to kind of overcome that barrier that's, I don't want to price it so high that I don't get a single customer, yet you want to capture value, right? What are you seeing in being effective with that?
So, all right. So I'm going to be quite reductive to say, if you only have 1 potential customer, then you might not have picked a market that's big enough anyway. And so you might as well be willing to lose 1 potential customer by giving them a price and shocking them so that they'll never talk to you again, because at least then you've learned what's too high. You shouldn't only be having 1 prospective customer conversation ever, right? You should be having multiple. And so I think part of this is about figuring out if you have multiple, fine, for your first 5, cite 5 different price points. If 1 is way too high, you've only lost 1. If 1 is way too low, you'll still kick yourself, but at least it's only 1 of 5. Especially in the very first days, don't think you already have to have like a perfect list, everything figured out. Like, you can test things and see what works. If you feel a bit like, oh, but we're talking to this like important enterprise, like they expect us to have a proper price list. Well, you can still print a document that has like your price list. You're just going to change the numbers next time. Please don't do this like after you've already amassed like 10, 20 customers. At some point you need like structure and streamlining. But the journey to product market fit is figuring out things that are what are the ways the puzzle pieces click together. And so in product, we're allowed to have a sort of mindset of, well, let's experiment. Well, we can do that on pricing too. And those are the crucial conversations where you can actually test out what is that pricing point that's going to work for people. So like first 10 customers, test. Don't try to perfect. Don't be afraid, because if you lose 1 because you cited a price too high, well, that is far better than citing a price that's way too low for like 5.
Point well taken. So I want to shift gears slightly on this whole question of this SaaS, or what I like to call XaaS. And at least as I think about it, I think that it really has started to become an omnibus term that refers to multiple things, right? On the one hand, there's a product delivery model, right? Salesforce started the whole thing instead of shrink wrapping CD. So there's a product delivery model. There's a payment method, which is, hey, I take X dollars and I split it up into 12 equal payments, and voila, you have a SaaS model. And it's also a pricing method, right? So what are the interdependencies? Which is the chicken? Which is the egg? Which comes first? And how should a founder who's starting out with a new product think about pricing in terms, or this XaaS model in terms of these 3 different dimensions? Any thoughts on that?
Yeah, so I often split that framework into the sort of 2 parts of the delivery model and the broader commercial model, if we can put the payment and the pricing methods together. The delivery model, in some ways, now in multi-tenant SaaS is kind of here to stay. Sometimes we have on-prem. That is the world of software where it started, right? It kind of doesn't matter, right? What you're really doing is you're saying, hey, I, the vendor, own a thing, and you, customer, will get to use said thing. That's our exchange of value. And so the delivery model itself actually that's the proof of the XaaS model, as you said. It can work across different industries. That's fine. We actually don't need to focus on it as much. The one area where you do, where some of the sort of classic SaaS things don't apply as well is if you don't have an ability to measure your customers' usage remotely, you sort of do miss a little bit of potential pricing research. So you have a little more complications there if you can't see that as well. But that's sort of like a very small thing. But on the other hand, it's really we have the commercial model. And in some ways there, we can even further say that actually you have what really is the magic of the SaaS model from a financial standpoint is the idea that you actually are getting paid upfront and you have a pretty like certain amount of money that you're going to get over time, right? But then it could be monthly, it could be annual. All of that doesn't really matter, and it could be based on how much usage you've made. It could be based on how many seats you have. It could be based on how many units of hardware you bought. Like all of that can be very different. The key to having it financially look and feel the same is that you're saying, like, and this is usually not generalizing, I am guaranteed to get a certain amount of money upfront that lasts for a certain amount of time and then covers the usage of whatever I'm delivering. As long as that's there, you can play around with whether it's usage-based or it's consumption-based or it's outcome-based or it's license-based. Are you doing overages? Like, there's a ton of different commercial terms after that, but it's the core ethos of, actually, I'm getting paid in advance, I'm there for creating deferred revenue, and on I go with my life. That's really what defines it as an XaaS model.
So just to make sure I'm understanding what you're saying, right? What I think I heard you say is this whole XaaS model from a payment perspective, commercial perspective, has two dimensions. The first is, in my mind, the more primary dimension is profitability, right? Which is the financial aspect of it. Make sure that you're making money off of this and you're not losing money. And therefore, at the highest level, whatever it is that you're using, ensure that you're covering costs and you're making some X amount of profit. Okay, got that. Then you talked about the commercial side and say, okay, now let's figure out how to split the pie or dress it up in different garb, right? And make it in a way that makes sense to the customer, which is the commercial terms of the pricing. Am I correct in?
Yeah, and so the commercial terms might look very different from industry to industry, a company to company. That's fine. The reason that financial investors have liked this model over the past 10 years is that customer lock-in effect. If somebody comes, says, I want to buy from you, I'm paying you up front, and you can forecast that out into the future. So as long as the model works like that, it's fine. But for example, if you were to do it to a model where every single customer is paying you as they go on a per transaction basis, that's not delivering you the financial level of sort of predictability that really is why this model is something that you see founders in other fields gravitate towards. So if you're interested in gravitating towards that method, even though perhaps the rest of your industry hasn't done that yet, or it's sort of newer for your industry, that's the part you need to make sure that is sort of consistent in order to deliver probably the reason you wanted to go in this direction itself, which is that maybe your investor told you that it would be a good idea.
It sounds like step one is to make sure that you're covering the profitability base and then go from there, right? Am I understanding that correctly from a founder perspective?
I think one thing to determine is all companies are not set up to be as a service companies, right? So before we even assume that we're in that world, we should check, are there some basic sort of principles that your product meets? Because otherwise you probably should be going there in the first direction, right?
Yes, I love it. Yeah.
Right? So the very most important one is, will the value that you're providing the customer through whatever means, is it hardware, is it software, is it services, will it be continuously demanded? That is, will people want to use your product, service, thing on a recurring basis? Because if they don't, then it's kind of hard to make a business model that assumes that they're getting continuous value, right? So that is the number one thing to double check first. I mean, think about it. If you file taxes annually, do you want to pay somebody every single month to do 11 months a year they do nothing, and then 1 month they do something? That would make no sense, right? So tax filings, no. Maybe sound like the bookkeeping service to keep track of all of the monthly closings with an annual tax filing makes sense. But there's a continuous value exchange between customer and provider in that case. And I think that's what you need to figure out, is that possible to do with your product service thing? Software has naturally, historically, always fallen into that bucket in almost all cases, because we check in on our major programs on a sort of very continual basis. The area actually that software sometimes has a challenge becoming a SaaS model is when actually the value is in the data you start storing in the software. because suddenly it's sort of like data stored. It's not necessarily the data being used or read or analyzed. And so that can be an area that even in software sometimes isn't obvious, but clearly there's a value in not losing track of the data and being able to access this when you want to. So it's not like usage needs to be every single day or every single week at the exact same frequency, but it needs to happen often enough that there's a value in having something continual in place. If that's the case, then you can make a business model that charges for continual usage because the value is perceived in that way. If the customer doesn't perceive value in that way, then just don't force them into that direction.
Are there examples of companies that fell into the XaaS pricing model that you think shouldn't have? Can you give us examples of?
It's hard to think of a specific example as such. Some of the cases that I have as an investor sort of diligenced in the past and looked at, but I decided to not invest in, would include companies where actually somebody purchased a piece of software. This is the most common case in order to solve a project-based need. Perhaps they needed to build now it's a little bit of making up an example. So not speaking about a specific company, but they perhaps had a lot of data and they needed to create an algorithm to forecast future demand for a certain product they were going to roll out. Once they have collected that data and sort of built that model, they might not need that software anymore because it was a one-off, one-time thing, so to speak. That's sometimes things that will be charged in software because, you have access to our great model-making software, but actually it's being purchased for a one-off thing and not for the long term. For example, that actually sometimes can still work is if the things will happen over and over. So take actually software that supports construction sites. A construction site, you kind of don't want it to go on for 5 or 10 years because if so, you kind of have a problem. Or it might just mean that you're working on public transit projects because they do go on forever, right? But most of us, when we build a house or we renovate something, like whether it's commercial, residential, it should probably only take 6 to 12 months. So the software you would use to keep track of what's happening on the project site, it seems like that shouldn't work, right? Because after 6 months, then they won't need it anymore. So actually they just needed project software. What can work though, of course, is if you're selling it not to the person who's commissioning the project, you or I would only need that once. You're selling it to people who will they're the people who will use it every single month, every single week. That can work. Or maybe it's an enterprise. Well, they will buy it for this project, but then they're still going to shift their licenses to the next project. So you have a semblance of somewhat being reoccurring anyway. But that hopefully gives an example. It's sort of very hands-on of this is a project, this is continual. It's something that it's a core business activity, continues on and on and on.
Before we dive back into our conversation, I want to tell you about Seed to Success. Seed to Success is our community letter with our proprietary insights on startup financial storytelling, tips, new episodes, and much more. If you find these discussions helpful in your entrepreneurial journey, use the link in the description to subscribe to Seed to Success today and get all of these and much more straight to your inbox every week. Now, back to our conversation. That's a great example, and that brings us to this issue of value, right? What is value and how often is that value extracted by the customer? So we hear a lot about the value metric in terms of pricing. So what's your view of the value metric? How should it play into the startup's pricing method, and what actionable advice or pointers would you give on that?
I'd say that if you feel like your pricing is off, what might be the case is that pricing levels, if it's too high, too low, that's one thing. But sometimes if you sense that your pricing is off, it actually might be the value metric that sort of feels off. And usually the way you would tell that is when you're damn, that customer is getting a really good deal. They use it so much and yet I get so little money from them. I'm really annoyed about that. Or conversely, it's ooh, they pay a lot for this and we're a little concerned that they might leave us next year and not be a customer anymore. If you're saying that to yourself, that probably means that your model isn't actually charging for the value that people perceive or how much they're actually getting from it. So those are sort of the telltale signals of what you might say around the coffee machine that leads you to have that conclusion. And so then the question you really do want to ask yourself is, wait, is there a different metric by which I should measure value, right? So classically in software, it's been seats. So it's really been employees. How many employees will need access to this software? But that's obviously just one potential metric. There's like the number of metrics. You could have a metric based on how much data is being transferred, how much data is being refined. That's usually very common in the infrastructure world, right? Processing power, for example. But to come back to our sort of construction world, maybe it's square meters that you're serving somehow, or number of buildings, or if it's logistics, number of miles delivered. Like, the point is, it can be anything you can measure in a different way that sort of somehow relates to value that is easy for the customer to for the potential customer to understand. So as long as it's easy for them to understand, it really can be very different. And what, obviously, to complicate it further, many companies don't have a single metric, right? So they might have a combination of, oh, well, there's a fee for using our platform in general or being our customer. And then there's a sort of sliding scale depending on how much you use of a certain thing. But also, by the way, if you want our add-on of our fancy premium feature, then that pricing models can be complex. They shouldn't be overly complex because then you're just adding complexity for complexity's sake. But you can test around with them, and sort of that is what the value metrics might shift, how they might shift.
So is it fair to say, based on what you just talked about, what I'm hearing is you laid out the bookends, right? Like, when is it too much? When is it too little? But also I heard something around, especially for B2B, what can you tie it to in terms of their bottom line, right? Is it a revenue driving kind of value? Is it a cost reducing kind of value? And then use that and connect it with a metric that you can measure to be able to price that and then come up with a value metric. Did I get that right?
Yeah, I mean, at the end of the day, pretty much all software in the world eventually boils down to it's either going to make you more money or save you more money. That's kind of the name of the game. That is literally how companies work. So for sure, it is absolutely true that the sort of value metric does get tied then to ROI of some way, right? Like, because if you use X more, where X in this case is the value metric, therefore you will save more money or make more money. That is absolutely the correct way to think about that.
Got it. So that sounds like the right starting point when you're thinking about the value to your customers. Say, okay, how can that now lead us to a good, value metric, and then therefore the right.
But, and one thing, and here's an example of a company I've worked with, is different value metrics might be more continuous than others. And remember, the key here is to have continuous delivery of value. And so that's one area to think about, because in some ways it will also shift your product roadmap, and that's okay. Because if we want to go into this sort of as a service model, we want to shift ourselves into something that's delivering continuous value. So recruiting software. Okay. We could charge based on the number of candidates we're hiring for. But we're not going to hire the same number of candidates every single month of the year, right? And so if we only do that, we're actually going to have really fluctuating demand, and we might see customers arrive and customers leave because actually they're not going to need that all the time. And this is where many recruitment softwares instead will say, okay, well, we'll charge based on the number of employees you have total, or we'll charge based on the number of how large your recruitment team is, like how many recruiting managers will you have. And so that's a specific example of a product you build might be the same, but actually depending on which of the value metrics you pick, and there I gave 3 examples, you're going to see a difference in retention, for example. There's the value of how much each customer should pay, but there's also a tie into how does this help the customer think of in terms of continuity of sort of value delivered. Where, for what it's worth, right, if you then end up charging based on the number of recruiting managers as compared to the number of sort of candidates or sort of positions filled, you might end up building out more features to make it more useful for a person using it, right? So how can you personalize your space more? Something that sort of makes sense for a per user basis, and your product roadmap ends up being pushed in that direction.
So all of this is kind of pointing to the importance of really understanding your customer and really knowing kind of how are they using it in their context and what does value mean to them, right? Which brings us to the question of research. And you mentioned research earlier as being really important. So what do you mean by pricing research, and what's the important, like, what are the things that the founder needs to keep in mind when doing pricing research?
I mean, you said it yourself. It's really to understand value. At the end of the day, it's to understand how does the customer perceive value? What do they find valuable? What do they find less valuable? Therefore, how willing to be to accept a different pricing model? And specifically, at the end of the day, you're trying to get to what is their willingness to pay. So WTP is pricing people would abbreviate that for a certain product. That's the goal of your research, is to sort of figure out the better answer. What will frustrate when you founders are is that if you're an early stage company, yes, you can do research, but it's not necessarily going to get you to a better answer because you don't have as many customers, as many data points as giant companies. So that's where early stage pricing is probably, it's more art than sort of later stage companies where they can have pricing specialists who have a lot of theoretical models. That's we're talking about elasticity of demand, yada, yada, yada. It's probably we're not there yet, right? If we're a growth stage company, that's not what we need to focus on yet. That doesn't mean we shouldn't be doing pricing research. It's just the pricing research is usually then more qualitative than quantitative.
So can you just walk us through, like, what should the founder focus on in doing qualitative research? And especially in terms of B2B, because they're hunting elephants. They're not hunting an army of ants, right? So there just isn't that quantity for them to be doing, and they have to use everyone that they have carefully.
So we already got into this a little bit, right? Where I actually suggested that the research is actually testing models in sort of prospective customer conversations too. That is a type of research in and of itself, right? Just to sort of super generalize, I think now this is assuming that you do have some customers, you like, especially in their stage, you sign to your long tenure customers, they've been your advocates, your design partners even. They are actually probably one of your primary sources for good input here because they want you to succeed. There's somebody on the inside who has decided they're going to champion your company. They believe in you. They want you to succeed. So actually just like ideally have a discussion with them if you are considering changing your pricing model to understand, so we were thinking about this. Do you want this? It's like, how do you think the rest of the industry would see that? Or have you seen another product that works like that? Have it as part of your general discussion and frame it as, obviously the framing of those conversations is usually, how can we deliver even better value to you? What could we be doing better? I mean, that's where sort of, you asked me for earlier, what are some of the biggest mistakes? Well, the clearest red flag that you're actually like pricing too low is like your customer might literally tell you, how are you so cheap? Like, how can you deliver this in this way? Why would they tell you that? You think, wait, that's being stupid. They should just like the price. Well, they don't want you to go under as a startup either, right? That would be bad for their business. So in some ways, while people will always want to get the better of themselves in a negotiation, they also don't necessarily want to pay 10 times less than they need to for something, because in that case, you might not survive as long as a company. So really like using your design partners, not just to design a product, but also to support you in designing a pricing model is actually very, very helpful as well. Really in that like when you really don't have like 20, 50, 100 customers, you're very early stage still.
And on that point, do you have any concerns that customers might, I hear your point about the don't charge 10% what you should be charging, but within a certain zone, right? I don't have an interest. My incentive is to not tell you what I really will be willing to pay, because then I'm going to lose my negotiating power with you. So why would I tell you the truth? And how can the founder overcome that?
But that's where I think that one needs to distinguish pricing research about pricing models and pricing research about pricing points. Pricing models, we're trying to figure out what's the value metric that makes sense here. How should we think about this? Would it be helpful for you to have like, is a 30-day or 90-day payment term really going to make a huge difference to you as a company? Or there's like other questions that are actually pretty important to the overall profitability of your business that people will be more willing to be open about than maybe like the ultimate price point itself. And at the same time, in an enterprise negotiation, there is more to negotiate than the price point itself as well, for sure. And so like design partners for the first, I agree with you to some point. You can't just say, hey, what do you want to pay me? And expect people to be 100% honest on that. That's not necessarily the suggestion. That's rather where my earlier suggestion, like try high, see what the reaction is. And then you sort of go from there. You learn what the price point is through the negotiation itself.
So it sounded more like you are understanding the pricing structure first and how to get that right and the architecture of the different elements of price. And then you leave the actual price point to later where presumably you've got a much better sense of value and so on and so forth.
I mean, we've still some rules of thumb, right? Like the sort of back way into that too is that if you have a calculation of what you think the ROI is going to be for your product, then your price is going to be a fraction of that ROI that you deliver. It's probably going to be like, you're not going to get the same as their ROI. Obviously, the more with the point of purchasing your product, you're not going to get even 50% of it. But you shouldn't be charging less than 1% of the ROI. That would be like also ridiculous. So like 10% up to 20%, that's usually like the rule of thumb that people talk about. So you can use that as sort of like a sanity check for where you might think that you might want to land.
I love that because it's almost like you're charging a commission to them for generating that return, right? That feels...
At the end of the day, that's kind of what it is, right? The more certain, the more happy they should be to pay a bit more. But reality sometimes, like, that's where budget caps and other stuff obviously can come in between. But theoretically, that makes sense, right?
Great. And then the last thing I want to ask about in terms of pricing research is obviously you're living in a world of competitors, maybe direct competitors, maybe other, alternative substitutes they're using. Where does that come into the picture? How important is it for an early stage? Should they even be thinking about this? And if so, how should they be thinking about it?
I think you should always be aware of what your competitors are doing. That's part of basic business sense. You need to know what your competitors are doing because it's important to understand how your industry is moving. But that does not necessarily because you're going to price exactly like them. What's more interesting is trying to understand how much your customers are comparing you directly to a competitor. If there's a lot of direct comparison going on in your industry, it usually means it's a more established category. And so products are starting to converge and they start to look a lot more like each other. And so each individual vendor has a lot less pricing power. That's a harder environment to be in some ways than one where actually competitors are still quite differentiated in the sort of types of customers that they serve. And so the best advice here is you keep track of your competitors. That doesn't mean you need to price exactly like them. In fact, you kind of want to do the opposite, where you want to try to figure out how to differentiate your product from the rest. And you can differentiate this based on either product features. Perhaps you do have a really sustainable competitive advantage that's very different. But you might also differentiate based on customer segment. You kind of serve these types of customers and sort of positioning and messaging. And then you're trying to do that so that customers aren't choosing the better apple versus like apples to apples. It's actually apples to oranges. So for some customer segments, you will be a worse choice. And that should be okay because you want to be the best for some people. That's really what you're trying to go for. And so that's why you need to know what your competitors are doing and how they're pricing so that you can figure out how to be different and sort of take over and to be the very best choice for somebody.
Got it. And the last question
I realize that's a little like wishy-washy, but hopefully helpful.
No, it is because it reminds me of, and I read this business case about how Pratt & Whitney changed the pricing method completely for aircraft engines. The power hour or whatever it was that they called it versus just selling engines and maintenance contracts separately for aircraft engines. So your point's well taken. The last thing that I have for you on that is a lot of these companies are creating new products that potentially don't exist. So is there anything unique or special that you haven't already talked about in terms of pricing research that you think they should keep in mind?
No, I think in this case, right, you don't have other competitors to compare to. So often the biggest challenge here is you're like, I have no idea where to start. Because at least if you have competitors, you like, when we're talking like 10x more expensive, 10x less expensive, well, if you have competitors, you're probably not going to land that far off them. So you kind of still have like, here is my ballpark. I need to figure out like which corner I want to be in, but I know the perimeter. If you're brand new, you don't know the perimeter, and that can be like really scary. So the beginning of the conversation, I mentioned that one of the questions I like to ask founders sometimes is sort of what type of product or what similar things might a prospective customer position you as? Do they think of you as, in this case, this is my previous company, retail experience technology? Great. Well, then I need to understand what are the other types of retail experience technology that people pay for that might be super different, but still like that's kind of how they would think of positioning. So for context, the company I was working for, we sold a 3D foot scanner and accompanying software to retail stores in order to allow prospective then shoppers to measure their feet and get the recommendations of the best fit footwear in that store. So computer vision, very techy product. It had a hardware as a service model indeed. Yeah, there weren't a lot of competitors. It's a very specific thing. But many companies thought of this is innovative retail technology. What we're doing at the end of the day is we're trying to differentiate our brand as this sort of retailer from other brands by offering our shoppers a better reason to come and visit our store. So what you're trying to compare to then is like products that don't do like literally the specific features are nothing to do the same, but what is other retail experience technology? What else is out there? And how much therefore are people paying for those things? So that's kind of how you would then try to figure out what's the willingness to pay for like those types of things. Because otherwise, and it was very specific, I said retail experience technology. Theoretically, if it's like literally what we're doing is 3D scanning people's feet, I could just sell you a measuring stick. That would cost me $1.
Yes.
I'm going to charge you a lot more than $1 for my product. So it's really important I position it in such a way that you think of it as a sort of high-tech new experience that's going to draw people to your store. And those are the other types of products I want to compare it to. So it's a little game. I would say the best advice there, if I can give, is to think of how can you think about the positioning of your product in terms of maybe there's a specific product category, but what's the broader product category you're thinking of and how much budget do people give to it? Where does that budget come from? And which department is it for? Those are sorts of maybe like at least anchor points to start thinking of, is this a high value or low value product?
That makes sense. And I know, we're kind of coming up on time. And the last thing I want to talk about is all of this is excellent, but at the end of the day, somebody has to implement a price, right? Mm-hmm. So I just want to, get your thoughts on what does implementation mean in your mind? What is the most critical part of price implementation from an early stage startup's perspective?
Yeah, so one important thing we can distinguish here, it depends on how early stage you are. If you are still less than 10 people, then you might not need to document you're so early stage, you're still getting your first customers. If you have a sales and marketing team already in place, like not skipping ahead of the training, the price list, that portion is actually really important to not skip that. So we can distinguish between those two. But yes, you sort of don't need to write the amount of documentation you would in a large enterprise company if you're like 5 people still. So getting that out of the way first. Now we're assuming you've made your decision already, okay? So communicating that to the rest of your team is a great place to start, right? So you're going to communicate it, explain why you're doing it, how it's going to work, because you're going to need your team to be able to defend it to prospects, right? So that's a pretty important step one. You will then want to update your documentation, prepare either a website if you list on your website, or prepare your pricing lists. With pricing lists, usually if you have an enterprise sales team, comes also allowed discount lists, etc. So there's a lot of things that follow on there, right? Then generally the questions come to, there's 2 types of questions that companies would often have to decide on, which is that first, do you treat new and old customers in the same way or differently? And then do you do it all at once or gradually? That's really your basic choices, right? Depending on how large you are and how quickly you're growing, like maybe you can grandfather in the old customers and you kind of just, it really doesn't matter because most of your future revenue is ahead of you, not behind you from your existing customers. So that's one thing that would make that decision quite easy. Don't focus on them. Generally speaking, still, it is far easier to change pricing for customers that aren't like prospecting customers because you don't need to communicate that there's a change. Nobody knows that there's a change because they haven't talked to you about pricing before. So for them, it's the only reality that they know. So that's usually the lowest risk place to start. You start rolling it out across new sales conversations. You see what happens, basically. Then you would go back later to your existing customer base. The most straightforward way to do this is that you do it on renewals. So you're doing it on renewal cycles, which should mean that after a year, you have moved through your customer base, essentially. At which point you might be ready to do another change anyway. So you might do that. Or if you do have customers, obviously in sort of a monthly billing schedule, then you'll cycle through that a bit more rapidly as well. But those are sort of the two major dimensions that you have to make a choice on. And that the most typical way is you start first and you implement in the new sales team, and then you over time do it on your existing customer base. And at that point, you'll do it usually when accounts come up for renewal, because it's a natural place to have the discussion anyway.
So talking of having the discussion, it's never easy to communicate that the prices are going to go up, especially early on. Customers have been loyal with you. Yeah. What are some good ways and bad ways to do that in terms of communicating price changes?
Yeah. I mean, first of all, don't pretend it's not happening, I think is sort of one thing. Like, it's sort of one of those conversations like, I don't really want to have this, and kind of procrastinating it because it's like not fun. You get the feeling, right? But as with most things in life, honestly, like being transparent, being upfront, saying what's happening, pretty clear. Making too many excuses for it this is where I think different companies have different approaches. I was at a pricing launch recently where some of the participants were shocked to hear that one of the companies was like, oh yeah, we just raised them. We don't even communicate about it. Oh yeah, nothing really happens. So in some ways we were like, oh really? That doesn't sound very nice. They have a lot of, this is an SMB sale, so they had hundreds, thousands of customers. So it's almost more like consumer-like in that sense. And after digging, it seemed like the actual purchaser wasn't the user. It was there were a lot of reasons that perhaps this would work in well in that case. But I'm just saying there are extremes. So there's not one perfect way to do it, and different companies have different approaches. But yeah, generally communicating in advance that it's happening. Explaining why, if there is a why. For example, if it is increasing, then pointing out here are the feature value add that we've added over the past year. That can be a pretty simple way of saying, voila, value has increased. But also not overthinking it too much. Depending on the number of customers you have, obviously offering a call. The more important the customer, the more you should do to know in sort of a relationship-based way, as you would with most other things anyway, right? The more important the customer, the more you're going to be doing it with them in a regular call that you already have, a call that you set up, or a personal communication, right? So.
And are there specific principles, especially when it comes to increasing prices, right? From your experience, have you seen it work better when it's framed in terms of value, that, hey, we're charging more because we're now offering more? What are some other possible acceptable ways to justify you have to explain it in some way, right?
But I think there's an assumption there that you have to, by using the word justify, we are assuming that we need to be on the defensive about it, right?
Good point.
So I think in some ways, I think that the mindset is not one of being defensive about it. It's being matter of fact about it. I think it's actually where I would start from. So the example I gave there is that you would explain, here's the features that are sort of, this is what we have delivered to you. If you can't explain what you've delivered, then it's harder. If your product truly hasn't changed because it was completely mispriced before, well, then actually maybe you're going to be okay having some churn on those customers that will be churning because they're not your best fit customers anyway. And that's okay too. So it's just about thinking through logically, but not feeling defensive about it, because there's a reason you're doing that. Where I might avoid from those to use arguments that too many arguments going in the direction of, well, our costs have increased, so therefore, we have a really big team now. Your customer doesn't care about that part. That's on your side. Your customer cares about what have you delivered for them. So that's probably where I wouldn't try to feel like I need to justify it by having a team or having this. So.
Good points. So which brings us to the question of how often do you need to be looking at your price, right? So how often should a firm be or a startup be looking at their prices? How often should that be coming up for review? Are there any good practices around that?
So in some ways, I don't think that pricing should be completely separated into a separate silo or stream, right? Depending on how you operate as a company, you probably already have like annual planning cycles. You probably already have like quarterly roadmaps in the product team. You might have, we usually check our messaging and positioning once a year. Like there might be existing rhythms or cadences that you can attach yourself to, which sometimes make more sense than having a, let's sit down and review our pricing all at once every X amount of time. So in some ways, like one company that I work with, they review their ICPs, their ideal customer profile, once every 6 months. They just want to check, like, has the competitive landscape changed? Has our product feature set changed sufficiently? Are we seeing a bunch of different people in the sales funnel process? Let's check in. We don't have to make a change, but we can. What I would advocate for is that more often you just check in. Does it still make sense? If it doesn't make sense, then you make a change. If it does, it works. That's what you need to put in place if you haven't changed it for a really long time. What can happen more naturally, right, is that somebody brings up, oh, this starts to feel like a problem, right? In which case, if that's the niggling sense, then you fold it into sort of an existing stream so you know that, okay, well, let's go look at this. But as with most things, like it's always easier, right, if you get into the muscle of changing something like every so often. So an alternative way to do it is to say, okay, well, we have multiple geographies or say multiple product lines. So let's check in on one of those things every 3 months.
Great point. So you've covered a lot on a very tough and sometimes scary subject for many founders. So
let me just say, it's scarier for founders than me. I'm just sitting here saying what you could do. You're actually sitting with a customer base. So I really do want to shout out that is the harder position to be in. So I hope that some of this was very helpful for those listening.
I am sure it will be. Thank you. So kind of stepping back, maybe they have some elements in place, not all the elements in place. What are like the top 3 actionable pieces of advice you'd give somebody in an early stage, don't yet have a sales team, trying to get to product market fit?
Yeah. So to sum it up, so it's pre-product market fit company. We're still doing founder sales. So the top 3 things there is therefore to A, don't be afraid of using your design partners to also discuss pricing models. That's totally okay. And in fact, that's a good conversation to have because you're anyway discussing your product roadmap probably with them, right? Second, don't be afraid to test different levels when you go into pricing negotiations. Like until you've gotten one where like the person on the other side of the table is like, that sounds like a lot. Like you probably haven't tested the limit. That doesn't mean you need to set all of your prices at the limit, but it's helpful to know what it is. And the third to be that it doesn't need to be perfect on day one, right? If you check in on it every 3, 6, 9, 12 months, it's going to change over time. And in the pre-product market fit phase, your first 10 customers, the whole point is to learn from them. It's not to be perfect. So just testing different things is fine too.
Awesome. So is there, we've covered a lot. Is there anything that you wish I'd asked, but I didn't?
No, I think we've actually gone through like pretty much everything here.
It's awesome. So from my perspective, this has been an amazing conversation. I know it'll be super value added to many. So I want to thank you for your time and for all the insights that you gave us. Thank you so much. It's been a pleasure talking to you.
Thank you. Thank you for having me. It was really fun as well.
And that's a wrap for today. Thank you for tuning in. If you find these conversations helpful in your own journey, please subscribe to Seed to Success, our weekly community letter with tips, insights, resources, and more. If you have any other questions relating to startup finance or financial storytelling, send them over to me at chakras@achieve.co. That's chakras@achiiv.co. We'll see you on the next episode of Invisible Inc. Now, go achieve.